So let's say you're a contractor and you're finally ready to buy your first home. You've got the income, you've got the credit score, but you go to the bank and they say that you're too leveraged. What does that mean, Aaron?
Essentially means that you owe more than you're making right now, or you don't have enough available income in your personal life to be able to take on more bills.
So Hardscape Mentor teamed up with Beacon Funding to set you up with the tools to grow yourself professionally without sacrificing your personal goals.
That's right. We're going to be talking about a question that we hear a lot from especially new businesses.
That's right. And that question is, why shouldn't I use my personal credit to buy my business equipment?
Let's start with how personal credit is actually reviewed. If you apply for a mortgage or an auto loan or even some credit cards, the lender's going to look at not just your credit score, but how leveraged you are.
And that means how much you owe every single month.
That's right. If your credit card is maxed out, you have a big auto loan, and now you're taking on an equipment purchase, you're going to look highly leveraged. Even if your business is paying for the equipment, it still shows up under your personal credit.
So it's not just about what makes sense, it's about what makes sense on paper.
And here's the thing, being highly leveraged can actually bring down your credit score. Let's look at how equipment financing can actually help mitigate this risk. Let's say you take home $5,000 a month in personal income. After your auto loan and your credit card payment, that leaves you with about $3,600 in remaining income available to you.
So does that mean they'll approve you for a $3,600 mortgage payment?
Well, no. That would leave you nothing to live off of. How are you going to pay for your groceries and things like that? Instead, when you apply for a mortgage, your lender's going to look at your debt to income ratio. They're trying to look at your fixed expenses compared to what you bring home every month. They're going to divide your fixed payments by your monthly income to figure out your debt to income ratio. And this is what they're going to use to figure out what kind of monthly payment you can handle. They want to leave you with some money left over so that you're able to live your life and not put too much stress on your personal expenses. Now, if you take on a payment for an expensive piece of equipment, that's going to leave you with a lot less money to live off of every single month. A lender might not want to approve you for a mortgage payment because they feel like it's going to put too much undue stress on your personal expenses. Having this monthly payment extremely limits your borrowing power.
So what about using a home equity loan?
That's even riskier. Now you're tying your home to your business. Let's say your business hits a slow period and can't make its payments. Your home is now at risk. Instead, finance your business debt under your business with Beacon Funding. This separates your business debt, and that allows you to better protect your home and your business debt.
So you're saying instead of risking my personal credit score or jeopardizing my mortgage approval someday, I'm going to keep that debt right where it belongs, and that's in my business.
That's right. The equipment loan shows up under your business's name, and that separation protects your personal buying power. Additionally, by separating your business debt from your personal debt, you're protecting your personal life from the risks of operating a business.
So if you're wondering how to finance your equipment the right way, head over to beaconfunding.com/Hardscape Mentor, and we have a free guide there for you with all of Aaron's financial strategies.
There you can also unlock VIP perks like 100% financing, 90-day no payments, and even a Visa gift card giveaway. Don't miss out.